All right. So what are we talking about in terms of investing here? We're talking about early stage investing. And if we split that into four parts, it's arguable how you split this apart, but let's just talk about four parts of early stage investing. We're talking about the seed round or the early growth stage, somewhere in there, the time when the first outside money starts flowing into companies. And this is getting later and later as time goes on, but we'll ignore that fact. Right now, if you talk to entrepreneurs, there's plenty of them at Sunkalp. Most of them are sitting in the valley of death. Most of them are out looking for funders, don't have it. A lot of those entrepreneurs will die sitting in the valley of death, not being funded. That's literally what we call it. It's a horrible time to be an entrepreneur. Anyway, if you're an investor, you're looking for companies at that stage, and what you want to own some equity in them. So let's use this chart here. You're going to see variations of this graph a few times. How this works is this big green blob here, it's not to scale, is money being handed over from the investor to the entrepreneur, to the company. So there's some money going in, and then we have this gray line here, which is showing how the company's growing. So we got a nice hockey stick here, not too steep. And then if it's an equity investment, what's interesting is there's nothing here. This is all blank because you're not buying any cash flows. You're not buying any, there's no dividends being paid in startups. So you don't get any dividends. You don't get any interest payments. There's nothing that you get except a percentage of the company. And then you get paid back when someone else comes along and buys the equity from you, right? And typically that's an acquisition where they're buying all the equity. And so they're buying all the equity. Some of it's yours as the investor, and you get back some return. What's strange about that in terms of structure is that you're basically not being promised anything for any unknown period of time. We have a handshake, right? So we have a handshake that says we want to exit this company. We want this company acquired as quickly as possible. That handshake used to be 5-ish years, and then it became 7 years. And these days it's kind of like 10 years. We hope in 10 years these companies get purchased. But there's actually no promise. There's no written agreement that says in 10 years someone's going to buy this company. All right, so there's one more piece of this paradigm, which you may have heard of. So if you hang around investors, you will hear the number 10x repeated a lot. 10x as in the value I pay for the company now, the value when it's acquired needs to be 10x higher or more. More is better. But at least it needs to be at least 10x. I taught once at a one-day event for lawyers, specifically startup lawyers, because to be a lawyer in the United States, you have to take some continuing education classes. And they just had us who do this for a living come in and speak in front of them. That was considered continuing ed. I found it interesting just to see it from that framework. So I stayed the whole day. And the number 10x was repeated over a 6-hour period. It was repeated approximately 1,000 times, maybe 1,200 times or 1,500 times. It was like every 2 minutes. Every 2 minutes for 6 hours, somebody said 10x or exit. So where does this come from? Why is this 10x built into this paradigm? Why is it so pervasive that when you sit around with investors, they're just going to assume 10x or better, or they don't want to invest? All right, so why 10x? It comes to this chart. This was given to me by the most prolific angel investor in Seattle, who's now a VC, full-scale VC. And this is what he told me, which other people have told me since then. This is what a successful venture capital or angel portfolio looks like per 10 investments. And so if you're an angel, you may have only made 10 investments. If you're a VC, you may make 15 or 20 per fund. Let's do the math per 10 because it's easier. So 1 out of 10 times, this is how you read this. 1 out of 10 times, you hit a home run. Everything's in baseball terms for some reason. I'll translate that. That's good. So 1 out of 10 times, you got a 10x or better. 2 out of 10 times, you did okay. And literally, that's how they'll speak. It was okay. It was a 5x, a 6x, 7x. 3x, oh, God, yeah, it was fine. I got a 3x out of it. If it's not 10x, it's not good. Right? So you do okay. 2 out of 10 times, you get some money out. 3 out of 10 times, you get exactly what you put in, more or less. Could be a little bit less. Often it's exactly what you put in because there's a what's called a preference in the deal that says investors get their money back first, right? Exactly what they put in first. So if there's a small acquisition, often the investors will get back exactly what they put in, or 90 cents on the dollar, 80 cents on the dollar, something about that. That's not good, right? It's better if you put your money in the bank and it earns some interest than you just get your money back 3 years later. And 4 out of 10 times you get nothing. You get nothing because the company crashed and burned. You get nothing because the company stopped growing. Nobody wants to acquire it and it becomes a zombie. It becomes a perfectly good company paying all its employees, but it's not growing, so it has no value, and so it's a terrible investment. Lots of reasons why there's zeros. More often than not, it's just because the company failed. So if you just look at this as a whole from far enough away, something odd shows up, right? So professional VCs, the best venture capital firms in the world, do this. And they get to see the best deals, and they're only right 3 out of 10 times. So 7 out of 10 times, the California VCs are wrong with their investments, that they're losing money on their investments 7 out of 10 times. And if we do a little math to see, well, what's this return in cash? Because VCs do simple math. We'll just do cash on cash return. Well, if 1 out of 10 returns 10x, so that's your money back, right? So 10x times 10%, 1 out of 10, is a 1. So that's getting your capital back. And then 2 out of 10 gets you 5x. So that's good. That gets you some more profits. 3 out of 10 gets you a little bit more, 30% times 1. And 40% is zeros. When you add all that together, you get 2.3. And so is that what VCs make? Well, it's hard to tell. They don't like to tell us those numbers. What we do know is this study. This is a study of angels, not VCs. But one of the questions out there was, can angels make the same returns as VCs? And this study said yes. And it had some data about VCs, but mostly it was about 6,000 angel investments. And if you had invested in all of them, you would have made 2.6 times your money back. And it would have taken you, this is pretty old data, it would have taken you on average 3.5 years to get any money back. But most of those money back were less than 1x return. And there were a couple investments in this portfolio that did better than 30x, some between 10 and 30. But overall, the key information here is about 2.5 times. So the real goal for VCs is not a 10x return. It's a 10x return on a subset of their investments. The real goal is about 2.5 times their money back, 2.5 times cash on cash. If you can do that, you are a successful venture capitalist or a successful angel, right? Plus or minus a half. You can get 2, that's fine. You get 3x, even better. You're not expected to make more than 3x. It happens sometimes, right? Whoever invested in Facebook and Google made more than that in their fund. But in general, 2.5 times is a good return. So why 2.5 times? Why is that considered good? Well, when you do the math on 2.5 times, it's 15, 20% internal rate of return. And that's better than the public markets. So ultimately, the whole thing that boils down from this 10x is the idea that if you take more risk, you should get a higher return. And venture capital is higher risk than, private equities is more risk than public equities. And so you should get a higher return, 15 to 20%. Over 10 years, that is about 2.5 times your money back. And does it work? No. So this is a real result. I don't have the citation on here, but fewer than half of the VCs out there. This is real data. It's very hard. Again, it's really hard to find. Half of the VCs, professional VCs out there, did not return 1x on their fund. Another 35% didn't return 2x. If you can't do 2x in 10 years or 12 years or 15 years, whatever the lifetime winds up being, again, those investors should have just put their money in an index fund. 15% did what they were supposed to do, and 5% returned more than 3x, and they returned so much capital that investors are still putting new capital into venture capital more and more every year. All right, so that's the background on what paradigm we're stuck in. And the question is there another way out? Is there another solution? Is there anything this book can tell us? Well, before we go there, we got to look at the elephant in the room, which is debt. So if you go through everybody who's signed up to SongCalp and you go through all the investors and you look at how many say they're debt investors versus equity, I'm not sure they asked that questions in the profile, but you can see the word debt show up many times in those profiles. You will see that debt is much more common than equity in this crowd. And one of the reasons is there just aren't acquisitions in India or Africa. There aren't IPOs, and therefore that's not a good thing to do, right? Put your money down and hope that something happens someday in the future. And the only other way that most people know of to invest is debt. So just for those who've never seen it, here's a debt investment in my same graph. So you hand over some money from investor to company. They actually promise you something. They promise to make a series of payments. Usually it's the same size payments over a certain period of time. And the problem is, the reason why debt is failing as a mechanism for funding SMEs and startups is, well, we want them to grow, right? We're giving them money to grow. The companies I work with, we do want them to double, triple in size, just not necessarily in a year. So as they grow, these payments become affordable, but they're not affordable to start with. They're more than the company can afford. So what do we have to do? We have to give them a honeymoon period and push out these payments a bit. And then we take more risk. And then really we got to add more interest rate in order to make up for that risk. And ultimately, we're not going to get 2.5 times our money here, because that would be 250% interest, or it would be a long series of payments at pretty high interest. So ultimately, we wind up in this vicious circle where we need to charge more in order to make our 2.5 times, but they can't afford more, because the more we increase it, the more payments are unaffordable. We could try it, but we'll just find that our default rates go up and up and up. And so debt doesn't really work. It works for philanthropists who are doing work without regard to whether or not they make money. It works later in the life cycles of the company when they're up and running for, let's say, 5 or 6 years. And they have a track record and they have some assets to back up their loans. But I'm talking about that little sweet spot of the valley of death. That's not going to solve that problem. There's no way to actually make the numbers work. So what we really need is the other part of the book, which is the paradigm shift. We've all heard that word. All that really means is that we have to incorporate this knowledge and this experience and these facts into our system, and we need to come up with a new system, right? Simple as that. We need a new system, which is a new paradigm, just to be clear. We're not going to throw away paradigms. We're going to create a new paradigm, and I'm going to show you 2, in fact, that are new ways to invest in companies, and they both work. So 2 solutions, and let me go through them one at a time here.